What's up, everyone? We're here with the Holy Macro Show. We have Kashop with us today, as always, my co-host. We have so much going on in the markets these last couple weeks. I was saying this the other day, Kashop. I said, I say this all the time. Every single time I get on, I'm like, there's so much going on, but most of the time there is. But at the same time, it's like for me, I'm like just putting on the next trade, not really thinking about it as much. But I know people out there are always panicked, when the markets are going up and down. And, it's like I wrote a tweet the other day that it's Fed day and the market's volatile. Oh my God, like what a surprise. Like, this is how these things go. Like they're events. Some people trade events. I haven't met many people who can do it well. John Netto is one person who does it very well. If you guys read his book, I'm gonna give him a shameless plug here because it's one of my favorite books, but it's The Global Macro Edge, one of my favorite books. It's a big book. You get everything you need to learn how to trade. You get everything you need to learn how to trade bonds, whatever it is. He's the man. So I really enjoyed that book. Systematic trading is in there. Bond trading is in there. Day trading is in there. Event trading is in there. Trend following is in there. Whatever you really want to do, it's all in that book. I mean, it's a huge book too.
So when I first started trading, Jason recommended I think it was Trading for a Living by Alexander Elder, and then the second book you recommended was John Netto's book, and you were kind enough to talk to John Netto and get it shipped to my home in India back then, and man, it was a tome, but I think I got through it in a few days because it was that informative, and the way he describes how he treats trading as a business, how he keeps accounts, and
Yes.
how one not so funny incident, how Bloomberg, screwed him over and all that stuff. It's just action packed, and I cannot recommend it any more emphatically. It's a great book to read.
Yeah, I absolutely loved it because it's just everybody's always asking what books to read. Those are two great ones that just kind of give you a good template of how to do this for a living. Like a lot of people, like you could read most people want to read books about how they made the most money or the best trades. A lot of people don't want to read books how to do this like it's an actual business. Because really, like, if you want to trade for yourself, you want to trade for a living, you want to make money consistently year after year, you got to think about it like a business. You have to also figure out how you're going to sustain yourself or think about different ways of thinking about it. Meaning, I don't like to touch my personal account. So I always have different money coming in, different businesses. And that's something that I've always done. And so I think it's, significant to either understand like, hey, I'm going to do this, I'm going to have my trading account and I'm going to live off of this trading account. That's one thing. And the other thing is what I do, which is I'm not going to touch this trading account. I'm not going to pull any money out of it because for me that just stresses me out. Maybe some other people can do that, but the stress of going, hey, I'm just living off this one account, this is where all my money comes from, I that would make me think, okay, well, it's the end of the month, and it did make me think when I did this years ago. It's the end of the month. I've got this bill. Oh my God, my car blew up. I need to buy a new car. Like you start to think of those things, then you start to see your account and you go, okay, well, I'm making some money here. I'm not making money here. You start to make mistakes. You start to go against your trading plan and your trading methodology. And for me, I really enjoy just having an account that I know I'm not going to touch. I know I'm not going to pull any money out of, and I can just focus on trading. And then I have other businesses. This is where the trading for a living idea kind of comes in, which is yes, I'm a trader, but I also worked for funds. So I have my own accounts. I'm trading that. I'm not touching that, but I'm also working for a fund. So I'm managing fees. I'm getting management fees. I'm getting fees on top of that when I make gains. There's lots of different ways to do that. 2 and 20 is the original way, 2% of the overall account. So if somebody gives you $100,000, you make 2% of that a year. And if you make gains on that, you make 20% of those gains. So if you make another $100,000 on that 100, so you have 200,000 at the end of the year, you'd make $20,000. So, that would be where the income would come from for me. And then it turned into, okay, well, now I've made a bunch of money. What do I do with this? Now it's okay, I have other investments. And what's other things that could possibly make me money? Well, I could start in other businesses, which I did, or I could start investing in different real estate operations, which I did. or whatever it is, like however you're going to do it, but just kind of come up with different ways of making money to kind of pull that stress off of your head. It's the even running like, the newsletter and, working with other companies to put out different information. This also are ways to continue to bring money in as a trader. So I can just focus on my accounts, which at the end of the day, that's really what I love to do, is just trade my account, understand what it is, and continue to grow that over time. And then, the other things, those are just extra. And if anything was ever to happen badly, one of these investments in a business, or one of these investments in real estate, or let's say my investment account, if I really had to touch it, I haven't had to all these years, but if I really had to touch it, I could. So either way, I feel pretty safe. And then also the last part of this, which is I have multiple accounts. So people who subscribe to the letter, you guys see that there's multiple accounts. That's not a joke. That's literally, I've always had two different accounts, one long-term retirement, and then the other account is my futures and options trading account. So I've had that all these years. And then over time, there's been other accounts which are swing trading accounts. Maybe that'll just be stocks. That's something I've started in the last couple years. But now, if you just kind of have that type of diversification, now you're going, okay, well, now I'm diversified in my investments that I'm not touching. And now I also have these other investments over here that make me some income over time. And then I have these businesses that make me income as well. So this is the way I kind of do it. Everybody's going to be different. Everybody's going to have a different risk tolerance. But I think the reason why I'm always so transparent about these things is because I think that's the best way to learn. If you don't learn, you're going to have to learn from someone else some of these things. And the only way to really do that is someone to just be honest and be like, here's exactly what I do. This is exactly how I make my money. And this is exactly what I do with my trading account to not drive myself crazy. So I'm trading it every other day and losing money. Because I feel like if I did nothing but trade my account, I'd overtrade. And I guess I do have one more thing, which is, there was a time where all I did was work for funds. And, I couldn't even have my own account anymore. So I had basically put that money into a basically S&P 500 bond gold fund for a little while, which sucked. But I was trading for a big firm. But at the same time, at one point, I started to get in my head a lot more. I started to listen to clients a little bit too much. I started to do things that were kind of unlike myself one quarter. And so, really understanding that like my brain really enjoys the fact of having these different things happen, or even things like writing, my brain has to be active in that way, or getting on and talking with Kashop every week. Something that kind of opens up my mind to different possibilities as a trader. These things also help me trade very well. So I also know like I also function better the more I'm vocal and able to talk to people and writing and doing something like that. So hopefully that helps somebody out there who's looking at trying to trade for a living and different ways of doing it. You have anything to
Yeah.
add?
Yeah, just one thing, which is start a newsletter. If you are trying to trade, start a newsletter. And the reason for that is, I mean, it's not about free or paid. It keeps you honest. So I've been putting out a newsletter. I think so. I started in the business in 2016, and even when I didn't monetize it, I was still putting it out. I think on a frequent basis. So I had a Telegram group, and I was sharing my thoughts. And the reason to do all of that is that it keeps you honest. So when I look at a trade and I say, oh, I know this is going to go up, so I'm going to buy this stock. So let's just pick an example from recently. So I bought a luxury stock, and because I had the newsletter, I had to put my thoughts out on paper, which meant I had to actually, so I can look at the year on year revenue growth numbers and say, oh, it's growing. But then when I go and put it out in the newsletter, I have to actually do the math. When I do the math, I realize how quickly it's growing. So the magnitude, it hits me much faster. So now I'm a little more committed to the trade. I know a little bit more about the trade. So when you try to convince somebody that, hey, this is a good idea, you actually end up doing a lot more work and you develop a lot more conviction. So if you're a fundamentals based trader, just have a newsletter, because it'll keep you honest, it'll keep you working a little bit harder, and end of the day you will not regret it, because that is going to be where how you improve your skill, how you improve your alpha.
Yes, and that's great advice. And so let's hop into it because I think that's I hope that a lot of people got something from that because these are things that I wish I knew when I started in the business because I thought that especially if you look online, like if you're making you let's say you even have a $10,000 account and you're making 1,000% a year. I mean, you're probably a billionaire by this point. And so like you guys see, and I'm not like I am laughing at those people, but I'm not laughing at the people who read it. I'm laughing at the fact that, you see these things online and you see Twitter and you're sitting on Twitter and you're reading all this shit and you're just like, okay, well, obviously everybody knows something I don't. These guys are the best traders in the world, and every single year they're making 1,000 or 2,000 or 3,000%. Why am I not doing that? And then you start to get in your head about it, and then you think if I can just make 1,000% a year, I would be able to, I don't have to work anymore. I wouldn't have to do anything anymore. And I could take $10,000 to, 50 million or whatever. These are rare stories. They do happen, but even myself, like getting from the small numbers I was at, which is thousands of dollars, to the point where I'm at today. This took, over a decade to get to these points. In a long time and a lot of work, and a lot of failure, and a lot of, at the beginning, a lot of blowing up accounts, and a lot of misunderstanding what options, how options work, misunderstanding how futures work. So it took a long time. So, for the last decade, it's been consistent. However, it took a long time to get to a decade of consistency. It at least took 5 years of failures to get there. So, mainly what I'm saying is give yourself time. Don't be afraid to keep your day job. Everybody wants to, and everybody at the beginning of trading wants to quit their day job and just trade. It sounds awesome. I could trade from anywhere. I could be on the road. I could do this. But there's lots of things you can do from anywhere. And not to mention, you start to realize like how much money you would actually need to trade for a living. Like, let's say you have a family. Let's say you need about, let's $200,000 a year, which isn't really that crazy in the U.S. at the moment. So if you have about $200,000 a year, and let's say you have a $1 million account at some point, and you're like, I'm going to trade for a living, and let's say you have a year that the market just chops around and drives you crazy, then you're just like, okay, well, I have a family still. I got to take out 200K at the end of the year. And so let's say you're at a loss. You're at $900,000. You take out 200K. Now you're at 700,000. Now you have to start the year at 700,000. Let's say you have a year that's just chopping around, but you made a little bit. Let's say you go from 700 to 800. Now you need another 200K. Now you're down to 600K. Let's say that year's a bad year. So anyways, you guys get the point. It's just the amount of money that you really would need to trade for a living is a lot more than $1 million, possibly more than about 5, I think would probably make sense. But at the same time, is once you get to these numbers, like you really want to protect it. And so protecting those numbers, I think, comes into play when you start to diversify into different things, whether it's different businesses, different projects, something that's going to make you money in different ways. So anyways, let's hop into it. I could talk about this forever. I could talk about this for the next 5 years because it's probably one of the most important things, I think, for traders, and one of the most important things that I learned from other traders. I didn't learn it on my own. I learned it from other traders when I was like a hungry kid going, oh man, I'm finally at 100K. I can trade for a living, and them sitting me down and being like, hey, here's actually the truth, kid. And I was like, damn, that's true. Okay. So let's start with this one. So we've got Mike Burry back, talking about bubbles. Sometimes we see bubbles. Sometimes there is something to do about it. Sometimes the only winning move is not to play. I actually like this quote. I saw a bunch of people making fun of him, going, oh my God, Mike Burry's talking about bubbles again. You got to get long. And like, the guy isn't an idiot. And he's also caught a lot of these turns as they've happened, and he's sold his positions into them. So he's had some short positions. He's sold those put options that he's bought into these quick turnarounds, whether it was Liberation Day 2022. So what do you think about this one, Kashat?
So there's a Warren Buffett quote that there are no called strikes in investing. So I think that's what Buddy is talking about. So in a market like this, and here's the problem. So there's a difference between a bull market and a bubble. A
Mhm.
bull market is just, there are bull markets everywhere. So you go to China right now, there's a bull market. You go to India, there's a bull market. You go to the AI centers, there's a bull market. So you go to probably some parts of real estate, maybe Cleveland, there's a bull market. So you have bull markets everywhere. Now, bull markets are great. That's where you make your money. The problem with the bubble is that a bubble is like a black hole. It sucks in capital from all the other bull markets to feed one mega bull market, which we call a bubble. So when this happens, you see other sectors, other countries, other places where capital would be allocated, you see them start to get dragged down, and you see a lot of malinvestment in just one sector. So that's the difference between a bull market and a bubble. So now we are seeing a bubble, and this bubble is sucking in capital from commodities, it's sucking in capital from other countries. It's pretty much a global bubble now. So Nvidia is worth something like 16% of US GDP, and the at the dot com bubble, Cisco was at 4%. So that really tells you what the comparison is, the size of the bubble. And a lot of people, when they look at the statistic, they are like, how can you compare market cap to GDP? Well, if you don't compare market cap to GDP, then why would you compare the market cap to the earnings of a company? Why would you calculate dividend yields, earnings yields, price to earnings ratio, or any of these other metrics? So you always have stock and flow, and you kind of try to get a sense of how you convert. So you are in real estate, you know this. So you look at the cash flow, you look at the value, and then you kind of try to figure out whether the building is really undervalued or overvalued. So that's comparing a stock to a
Well,
flow.
hold
So
on,
you
hold
need
on.
to, yeah.
Let me be honest here. I have a great guy that I work with that does all of that stuff, and I do the financial part of that. So that's about it. So let go ahead, Kashab. But you're right. That's
Yeah.
exactly how you do it.
So a lot of people make fun of these statistics, but I mean, they're there to tell you what's really happening. So you need to make these comparisons. And even if you just do fundamentals, there is such a thing as relative valuation. You don't just look at, oh, this stock is trading at a 30 PE, it's expensive. Well, if its competitor is trading at 100 PE, then maybe that's a growing business, or maybe that's a cyclical business just getting into the recovery phase. So you kind of do a relative valuation as well. So with bubbles, the problem is it's sucking in capital from everywhere, and it is obviously not sustainable. But the problem with this particular bubble is, so Michael Burry nailed it with the CDS trade, the subprime trade, because he could buy insurance and that was cheap. But if you're trying to buy put options now, well, they are expensive. So how do you exactly hedge against this? How do you profit from this? By going short stocks, and that's really the only way to do it. But nobody wants to do it, just as nobody wants to buy the market bottom, because catching falling knives, you're going to get yourself hurt. So the other option is to just not play, to just wait it out, to wait it out in value stocks wherever you can be patient. So for instance, I'm happy to be in gold because I know that gold is something I'll be comfortable holding even if it drops. So be in sectors like that and just not play and let everyone else go crazy and then pick up the pieces after that. So I think he's spot on in this call.
Yeah, I think it's the scenario that people get into. I think it's a couple things. It's one, understanding the type of trader you are. For me, it's if it's a bubble, I'm happy to be long because I have a stop loss ready. I have an exit signal ready. That's fine with me, and I'll hopefully catch the upside and limit the downside. However, there's a lot of people that invest in these things and have no idea when they would get out. Like we talked about this, a long time ago, Bitcoin exit strategy. We had a whole video on this. If you guys check the channel, I think it's literally called Bitcoin exit or something. Um, but if you check out that video, basically what we talk about is when would you get out of Bitcoin? And Kashop's mentioning, his reasons for getting out of Bitcoin at that point. And I'm mentioning, I'm waiting for this to happen. And the answer why we made this video is that there's so many people who don't have an answer at all. It's just, hey, Bitcoin's going to go to $1 billion. You're an idiot if you don't own it. And that's it. You know, and you have to know where you're getting out. You have to know where you're going to get out of something. And also like what you're comfortable with. I'm very comfortable owning a bubble. There's not everybody's going to be comfortable with that. Kashop's going to go into different sectors that are obviously doing really well. I like the way you put it earlier. Like there's a bull market here, there's a bull market there. Like there's plenty of places to invest without going heavily into the AI bull market at the moment. It's like people don't know that. And not to mention, it's like people also don't know that these sectors are outperforming. Everybody keeps throwing the Mag 7 at me lately. You're like, look at the Mag 7. They're breaking out. They're doing this. Some of them are moving. Amazon or something. I haven't even looked at any of these charts, to be honest. So I could be off on some of what I'm saying. However, it's like, if I look at the Mag 7 performance and I look at the S&P performance and or technology even hitting 20%, I think it's at now. And then I look at gold and it's like 100%. I look at metals and mining, it's 70, 80% now. I look at the copper miners like breaking to new highs. I look at lithium making huge moves. I look at some of these stocks in these sectors like aluminum stocks, you know, 70% year to date for most of these. If I look at, you know, uranium, for God's sakes, you know, it's like so many people can't see this fact that it's like it's staring them right in the face. It's like you do not have to be in something that it might be uncomfortable for you if you don't want to be. You know, I have nothing wrong. You know, I own semiconductors still. I own some technology still. Nothing wrong with that. Just I know exactly where I'm going to get out. So, you know, if you understand that, hey, this could be a bubble scenario. This could be something that pops at some point. This is very strange that we have so many things moving so much with a very slow growth, kind of inflationary, crazy political environment in the United States at the moment, and you want to invest someplace else, go and do it. You know, so many, I feel like there's a huge stigma, and it's something you and I talk about a lot. There's a huge stigma of investing overseas. Like, oh my God, Kashop talked about China. Yeah, China's going to make us some money. Are we, you know, are we traders? And not to mention, if I said go buy Baba, nobody would even question it. They'd be like, oh yeah, Baba, great. But if I say, yeah, we're buying the China ETF, they're like, oh my God, China. It's like, it's the same exact thing. It's the same exact thing. And, you know, I think so many traders need to get their heads around the fact that, like, our goal is to make money. Like, if our goal's to, you know, if I'm running an ESG fund, and trust me, I thought about it just for the simple fact that so many people would give me so much fucking money if I did this shot. It's just like, hey, I've done, you know, Jason, the commodity guy, is done with oil. Great point there, AJ. The trade the trend until it bends. Absolutely. Uh, and so many, if I was a commodity guy and I'm buying oil and all these commodities all these years, and I was like, you know what, done with it, ESG fund, just doing clean energy products and so on, so many people would give me their money. I mean, these funds make a lot more money than most of the funds that I've outperformed most of these funds with my fund or any of the funds I've been a part of over the years. However, nobody's going to invest with me because I don't have a real story. You know, the story of I'm saving the planet looks a lot better than the story of I'm here to make you guys some fucking money. Like, sadly, that's the way this works. You know, performance is great and it matters a lot in this business. However, what matters more to people is feeling good about where they put their money. So, you know, at the end of the day, you got to like let go of that, because feeling good about where you put their money, those ESG funds have gone to shit. Like, they haven't made anybody any money. They've lost money, if anything, over the years. And there's been a lot better places to outperform. So, you know, I love the idea of, hey, we don't need to just invest in the United States. If you do have a position, great, but definitely don't be afraid to get outside. Don't be afraid to go to Europe. Don't be afraid to check out Africa. Very interesting right now. Latin America, something we'll talk about a little bit later, but you know, there's a lot of places to make money right now, and I think you got to really start looking outside the United States. So let's talk about the Fed, Kashop. The Fed day this week, you know, everybody was asking a million questions about it. We did a live during the event. right after the report came out, just because so many people were asking so many questions about it. So many people want to know what is the Fed doing? And I wrote a report this week that was like, it's Fed Day, who cares, or something like that, because I really don't care anymore. Like I used to care many years ago. Now it's like I don't care. I will listen to the Fed rate probabilities. I might see if their language has changed, but other than that, like it's like I know Powell's going to get on, say a bunch of words that nobody's really going to understand. I know that he's going to act hawkish and be dovish. I know that the Fed is very political at the moment. So for all these reasons, I'm just kind of moving on and going like, I'm just paying attention to the Fed rate. Okay, they lowered rates. Okay, we have quantitative tightening has ended. But I'm wondering for you, did you see anything in that meeting or anything from what they did that is changing your mind on our story of the commodity cycle moving, or the possibility of them stopping lowering rates, or anything that you saw in that conference that stood out to you?
So, if you go back to the 90s and you read the journals of the old traders, the macro traders from there, they would just write, they would have journal entries where they said, oh, the Fed came and did this. And it was a surprise for them because the Fed did not communicate that they were going to do this beforehand, and then they just did something. And now you have an environment where whenever the Fed does something, they let you know days, weeks, months in advance this is what they are doing, and then they do it. So the surprise element is gone. And because the surprise element is gone, there really isn't any surprise. So 2022, we talk about the rate hikes, and they started that in March. But in January, the news was already in the market that the Fed was going to hike rates. Now, the magnitude of the hikes, the speed, that was a surprise, but not the fact that they were hiking. And same way, so now that they have started a rate cutting cycle, it is not a surprise that they are cutting. It would be a surprise if suddenly they did a 75 basis point cut. It would be a surprise if they did a inter-meeting cut. So, they call a special meeting and then they do a cut. So those things would be surprises. What they are right now doing, it's not a surprise. Now, I don't agree that they are necessarily doing the right thing, because the element of surprise is an important tool in the Fed arsenal, and they have just given it up to placate markets. So, in this particular meeting, there was nothing surprising. There were two dissents. I mean, it was obvious that there would be a dissent. So, you know, I don't really think 50 basis points was called for. I don't even think 25 basis points was called for. They should have probably hiked, because what are they really thinking? There's a bubble going on in AI, and here they are cutting rates and saying they are going to end QT, which is just throwing more fuel in the fire. And Jerome Powell came and said that the Fed funds has no impact on AI spending, because AI spending is equity funded. He did not see that Oracle has been raising debt. He completely seems to be clueless about CoreWeave, which is massively debt funded. He seems clueless about what's happening in the private credit space, where all these infrastructure bills are debt funded. So I think Blackstone or BlackRock recently did a deal where they acquired a data center company from another private equity player. So he just doesn't see all this evidence, or pretends not to care, because, well, it's good to say that this is all equity funded, this is not like the dot-com bubble, and then just go about your business, while simultaneously saying that the Fed policy is causing wealth inequality, and while saying that inflation is hurting the people on the lower end, because it's the absolute price level that matters and not just the year on year rate of change. So he says all this, and then he acts like he's completely captured by the banking institutions, which the Fed is, because the Fed is a product of the commercial banking system. So I was not surprised to see bonds take a
Shop,
dip.
explain that a little bit more, because most people don't know that simple fact.
So the Federal Reserve System was created after the panic of 1907. It was created by a group of bankers who called it the Aldrich Plan. And because naming it the Aldrich Plan wouldn't really go well in a free market economy, they called it the Federal Reserve System. Took them around 6 years of campaigning and PR, and finally they got it implemented, and that's how the US became captured by central banking. So central banking, at the core of it, was a communist concept. It's one of the core tenets of communism, and it was adopted in the US in a stealthy manner. So there's a book on this called The Creature from Jekyll Island, which talks about the Aldrich Plan. how this came into being and how this was done so that the banks could make sure they could lend recklessly without ever facing any of the consequences. And if you look at what's happened, so there are these charts that go around everywhere, where if you look at the purchasing power of the US dollar since the Fed was created, it's just straight down, except for a brief window during the Great Depression where the dollar actually gained value. It's been straight down. And now, if you look at it from 2020 onwards, probably the dollar has lost 30-40% of its purchasing power, something like that. That's kind of the inflation rate that I'm dealing with as well. So maybe something like that. So, and there are every time at Christmas when Home Alone is released, people show these charts showing this is what the supermarket cost of the same grocery cart would be now versus what it was in the 90s. And you kind of see that this is what the Fed is doing. It's creating wealth inequality by making the wealthy people who own assets richer, and it's increasing the absolute price level. Now, for a long time, Americans were still getting wealthier because the dollar was a very strong currency and it enabled uh, every foreigners were holding dollars, foreigners were trading in dollars, and all the Asian economies decided to be mercantilist. So they started to export and debase their currencies faster. So standard of living improved, and then of course credit bubble. So standard of living improved, but now you have pretty high interest rates if you're taking on debt, and you have pretty the effect of tariffs, and the overall price inflation is getting pretty serious. And at the same time, layoffs are everywhere because all the SNAP benefits are going to expire or they have already expired, and layoffs are everywhere. So consumers are hurting. And in this environment, when the Fed cuts 25 basis points, what does it do? Well, it benefits all the big players who can access the corporate debt market. It benefits the US government, which now is $38 trillion in debt. But for the common man, well, it just means more inflation. So what's happening is you have layoffs on the one hand, which is rising unemployment, and then you have higher prices on the other hand, which is higher inflation. So we are heading for a repeat of the stagflationary 70s. And anyone who's read their history knows the stagflationary 70s ended with the US dollar not being a store of value. So in 1979, President Jimmy Carter, he had to issue US debt in Deutschmarks, which is the precursor to the euro, and Swiss francs, because foreigners did not want dollars. And we are seeing the same signs now. So gold has overtaken US treasuries as a central bank reserve asset for the first time in forever. So this trend is only going to continue. It's going to be worse. And I know right now it looks like the dollar index is heading towards 100. Maybe it's already there, but this is just kind of a last hurrah before the dollar really begins to dip. And this is all caused by the Fed. This is all caused by what they are doing because they are driven by politics. And Jerome Powell, even if he doesn't keep his job, he wants to make sure that there's no DOJ case on him once he leaves, like they're targeting the other governors. So he's just going along with the rate cuts, and who knows where it ends. But end result, all roads lead back to inflation.
No, I agree, and I think that's the thing that well, actually, you know what? I was gonna get to another chart, but let's bring this question up because it kind of leads me to talking about what I wanted to talk about a little bit. So a concern I have about the energy bull trade is if the AI bubble burst or AI models become more efficient, the AI energy demand could plummet, which could lead to lower energy prices. Your thoughts? So something that is this is a great question. I love that you brought this up, and I'll tell you how I think about it. One is if I'm not an economist, let's say I never read an economics book, and and not to mention I most of the economists I think are idiots, but that's just me. Let's say I never read an economics book. I know nothing about economics. What has inflation done over your lifespan? Can you think of being a kid, and do you think like are costs any lower today than they were when you were a kid? Anywhere. I mean, anywhere. Like, it's grocery stores, rent, housing, name something that's cheaper. TVs. TVs, a couple little things like that. Sure, possible. But for the most part, no. And so the way I think about inflation is I think about it in a very cyclical way. One, there's always inflation. It's just where does it end up? Sometimes it ends up in the stock market. You know, think of the 90s. People said there was no inflation in the 90s. Look at oil going to under $10 a barrel and so on. But what about the stock market? You know, the stock market, moving up. I mean, some years were over 100% in the NASDAQ back then. So, you know, that's money going somewhere. So that's inflationary in a sense. And then we get into the 2000s. We have, and once again, what has technology done over that time frame? So we're talking about the dot-com bubble. So the internet is finally everywhere. So things are becoming more efficient, I guess, supposedly. And now we're in the 2000s. And then money goes from the dot-com bubble all the way into commodities. So now we start to see oil bottoms out in 99 around $9 a barrel. And then we start getting oil starts to bottom out, and then gold really starts to move, and then silver starts to move, and gold miners start to move. And basically we're in a crazy commodity cycle for the next 10 years until 2011. 2011 happens. Everybody goes, look, inflation's dead. We had the Basel Agreement or the Basel II regulation and so on through the banks. We had all these things which made money go from, the commodities back into stocks, and these are all the reasons why. All I saw was the fact, I mean, yes, you could dig into all that stuff. However, what I see is the fact that money went from that into stocks again. And so the inflation went back into stocks. But for the normal person, money still, like, prices for things continued higher. It's the reason why they say 2%. 2% per year inflation, that's our target. It's really silly, and especially if you go back to what Kashap was talking about, you go before 1907, we really didn't have inflation. We didn't even have much deflation. It just kind of went sideways for a long time. And then the Federal Reserve starts to come into play when they really start to pump the money supply and manipulate currencies and manipulate gold and so on. We're talking through the 30s, moving into the 60s and so on. That's when we start to see these big moves happen in inflation. All of a sudden they say 2%. Back then, if you said, in 1900, if you said, I want inflation to compound at 2% a year, they would be like, that's insane. I mean, think about, like, just do a compound calculator, put $1 million in 2% a year, see what that turns into over time. It still goes up quite a bit. It's still compounding quite a bit. So, we get into that phase. So inflation is always out there. It just depends on where it's going. Now it looks like it in 2020, it started to move back in the commodities complex once again. The commodity cycle started up again. We started to see it really move. Gold moved, that started the move. I wanted to say it made a 52-week high in 2019. And then we got energy started to move in 2020, late 2020, really. So now we're kind of in the same type of scenario where gold started to move at the beginning of 2024, started to really take off in the last year. And now there's a possibility of energy starting to join the party. But all of these inflationary sectors and commodities are already moving. And technology has continued to grow over time. I mean, AI is here, obviously. It's already here. And people will always go, well, maybe it's short-term inflationary, long-term deflationary. You could make that argument, sure, but if it's more efficient, and we can also produce more, we produce more cell phones, we continue to produce all of these things at a quicker rate. Why would we do that? Is it just because is nobody out there buying these cell phones? No, because more people are buying them then. So we produce things at a quicker rate because more people are using them, which means even though things might be more efficient, we're still using those same commodities to build these things. So I do think over time, like, you will probably see the cycles work exactly the same way. I think people always want to explain away certain things, like, okay, the 90s inflation technically wasn't there. So let's explain it away by the fact that, hey, technology is so awesome, we don't need oil anymore. And that was the story. If you go back to 99, and Kashap, you've read this history, which is, if you go back to 99, we were done with oil. That was it. We didn't need oil anymore. The internet was going to change everything, and the world was different. Now it'll probably be, hey, probably the day oil bottoms out, it'll probably be like, hey, we don't need oil anymore. Yeah, we're going to need some of these other metals because we need, them for AI and the data centers and so on. But we're really not going to need any more of this oil stuff. And that'll probably be the day
2022
oil bottoms.
in
What'd you say?
2022 Mark Zuckerberg came out and said we are going to rebrand this now Meta platforms because we are all going to live our lives in the metaverse. No one's going to drive anymore. All that bullshit. And then what happened? Meta stock craters, oil goes up a ton, and the whole narrative got destroyed. And in fact, people started traveling so much that hotel rooms have become expensive. Flights have become so much more expensive. I think flight costs have gone something like 3x since 2019, since before the COVID pandemic happened. So it's crazy. Like every time you come up with some technology where they say, oh, this is deflationary, Zoom is going to replace meetings. Well, did it? It did temporarily and it does help, sure. But is that replacing conferences? No, not really, because now people are working from home. They want to go to conferences. So I've been to more conferences recently simply because I'm working from home and I want to meet people. So that's what happens. That's human nature. So there will always be inflation no matter what technology does.
Yeah, I totally agree with that. But that was a great question. I'm so glad you brought that up because it's something I talked about just yesterday. Actually, Dimitri came on the Gold Rush show. So if you guys check that out, it's right on the channel, last video that we did yesterday. But check that out. Dimitri and I talked about that a little bit. And we talked about sovereign AI and the commodity cycle. So getting to this one, so Rick made this chart. I asked him to share this with us today because it makes me think about, this global currency crisis that we kind of have going on. It's kind of a currency war. Not really trying to borrow too much from Jim Rickards, but it's a great name for it because everybody's basically at a race to the bottom. Everybody's raising rates, or sorry, lowering rates at the moment. Why did I say raising rates? Everybody's lowering rates at the moment at a level we haven't seen since 2008 or 2020, which is wild. Like, if you were in an environment where you were like, hey, what environment would you start lowering rates in? Well, the market would probably be down. Well, the economy would probably be doing this. Well, inflation would be under 2%. Well, you would obviously possibly under 1.5% back then. There would be all these reasons why you would say, okay, that's why they would lower rates. This environment doesn't make any sense. It's really surprising, and I think Powell said it best. I'm very surprised see a Fed chair so steadfast for a long time until it really got political and they started firing people. He was like, "Hey, this is we start cutting rates, inflation will come back," and he was very steadfast in that. And then it started to get political, and then someone at the Fed got fired, and then jobs got threatened, and then all of a sudden it's hey, look, guess what, guys? We're cutting rates. Everything's fine. So if we look at this right now, here's a great chart from Rick, kind of showing you like, hey, like people are moving into gold. And something else we talked about before on here, which is the fact that we're getting to major levels of reserves in gold compared to dollars. Like global reserves keep going down in dollars. Global reserves keep going up in gold. And that's not to say like anything about the price of gold, because I'm sure China and everybody else would be much happier if gold continued lower and they could buy it cheaper. And I think it's going to kind of be, and you could tell me if this sounds crazy or not, Kashop. I feel like it's almost like when people would say, when I started looking at markets, it was the Greenspan put, then it was the Bernanke put, the Yellen put, now it's the Powell put. I kind of feel like we have that in the gold market at the moment. So we're kind of looking at this scenario where no matter what happens, we're probably in a scenario where someone will come in and buy gold on any huge dip. If it got out of control for a minute, you'd probably see a bottom put in pretty quickly. And then also we have the scenario where everybody's cutting rates. This is inflationary. Like everybody thinks about it and they're like, oh, it's deflationary. It's this. It's like, go back to, any time in history. Yes, there's been rate cutting cycles into major deflation. Sure, 2008, 2020. But look what happens right after every single time. It's because, one, rate cuts don't initially get into the system day of. This is all just FOMO. This is all people going, oh, I think this is going to happen in the markets. Therefore, I need to do blank, buy this, buy that, buy this. That's not just money that just came in the market because they cut rates yesterday. It takes a while for that to get in the markets. So as they're cutting rates, think about COVID. Easiest example to look at. You have the market just crashing. The Fed goes, we're cutting rates to zero. Market continues to crash. Everybody goes, wow, they cut rates to zero. Yes, that didn't show up in the system yet. But what did they do next? They said, unlimited QE. Fuck it. Let's go all the way, guys. Like, so they do unlimited QE. And then, I remember this day, and I've talked about this once before, but for you guys who haven't seen it, I was actually riding my bike at a skate park in Cleveland. I go to the bank. I got to get cash out for something. It was back in COVID, and I think the credit card machine was down. So I went to the bank. It was a Huntington bank. I go in there. I'm talking to the person inside, and because I look at the ATM and my account says zero, and I'm like, that doesn't make any sense. So I go inside. I talk to the lady, and she's kind of confused at first, doesn't know what's going on, and then about 5 minutes later, she goes, "Hey, everything's fine. Money's all there. It's cool." And so I have no idea what's going on in the markets at this point. I go back to my car. I flip something open, maybe Twitter. I don't know what it was. And I see that we did unlimited QE at that time. So I don't know if we were at like a total collapse of the system at that point. I don't know what exactly happened, but that definitely freaked me out. But the point is, they did unlimited QE. The market went down a little bit more, and then all of a sudden it bottomed out. Now, what was the first thing to really move up? Well, it was stocks. People start speculating. Hey, at first it was, hey, we're all staying inside. We're all using Amazon. We're all going to Walmart. We're all doing this. So you start to see the Mag 7 and some of these consumer staples names really move. And then what started to move? The commodities complex. And then you saw this crazy move in the commodities complex. So what I've been saying the whole time is that we could see a short-term move in some of these things. Meaning, we could see oil chop around for a little bit longer. We could see copper even chop around for a little bit longer. But at some point, these cuts are going to come into the system, and it's going to be a lot of liquidity coming in the system very quickly from all of these different places who are cutting rates like it's 2020 and the market's hitting new highs and gold's at $4,000. So I do think the idea here is to continue to just take the signals as they come. However you trade, if you like Kashop, you're finding these value stocks in these unloved sectors like energy. If you're like me, you're waiting for these breakout zones to happen. For me, XLE above 101 is a great one. If you want to get some energy stocks, Shell looks great, hitting new 52-week highs. But also, just if you're really trying to front run the energy trade, I like the idea of owning the winners at the moment, some of the big name winners, and then moving down the cap scale as time is moving forward. So Kashop, looking at this global currency war and moving into gold, do you think this is going to continue to happen where these countries are going to continue to get out of dollars and into gold? Or do you think that there's a scenario where, they start to go, hey, we really do need dollars again? Or do you think that's done? You think we've entered a different regime?
So the way the world works in general, so outside of the trading world, is people are slow in making up their minds about something, and this is even slower when you increase the scale of the people making the decisions to institutions, to central banks, to governments. By the time something becomes policy, it has probably been debated for a year or two. Now, if central banks are saying we are going to shift out of US treasuries and put more of our reserves in gold, this decision was probably years in the making, and they're not going to reverse that unless something big happens, and they're not going to reverse that unless US treasuries say outperform gold for 10 years, and then they're going to reverse their stance now, because there is no possibility for them to reverse their stance. Because why would you? Because gold is outperforming pretty much everything else, and the way the US political situation is, the way the Fed has been politicized, the way the debt just keeps rising forever, central banks are just going to be like, nah, we are going to stick to our policy. Let's just stockpile more gold. And if you really think about it, the dollar has been a reserve currency for only something like 55 years. So before that, it was gold and the British pound. So there's always these shifts out of into a reserve currency and out of a reserve currency. And right now, what's happening is the dollar is losing its reserve currency status. So this is a trend in motion which will probably last decades until a new world power comes into place. Now, there is no possibility of a new world power coming into place. It cannot be China, it cannot be Japan. So if you go back to 1980s, people thought this tiny island called Japan is going to be overtaking the US economy. There were books about it. Americans were taught to learn Japanese and adopt the Toyota way. There were so many books where they talked about quality and all these things, and then Japan just went bust, and then those books disappeared. And we had the same thing about China, India in the 2000s. I think it was a Goldman Sachs economist who coined the term BRIC. So initially, South Africa was left out, it was BRIC. And every once in a while, there's a rumor saying the BRICS will launch their own currency and all that. And that's not really going to happen. So, what will happen is we can just see that the US will lose its reserve currency status, and probably there'll be more competitors for it. Gold is definitely the strongest competitor. Maybe if the Chinese yuan, maybe if they make it a little more convertible, maybe that will be a competitor. So the SDRs, the IMF special drawing rights, those were tried, they failed, and there's no way the pound is going to make a comeback because UK has so many problems. There's no way the euro is going to become a reserve currency because once again it's a economic union, it's not really a political union, though they are trying to make it that way. So that's not going to happen. So what we are really going to see is more of a multipolar world where gold takes a higher market share, US treasuries take a lower market share, and other institutions, everyone who sees the performance of gold, everyone who understands the value of it, the Asians already see it, the Americans are seeing it, Europeans already know it. So we're just going to see gold become a bigger part of reserve balances at every level, from central banks to governments to institutions to even sovereign individuals. So Morgan Stanley recently came out and said 60-40 is dead, let's do 60-20-20. So 60% stocks, 20% bonds, and the other 20% in gold. Now, in the 80s, I think it was, Harry Brown came out and said everyone should have 25% of their portfolio in gold. And people thought that was crazy.
Yep.
Maybe 5% at best, but not 25. And now we have Morgan Stanley saying it that 20% looks like a decent allocation. So in this scenario, I think gold just keeps going up and up and up. Sure, there's going to be volatility whenever it goes parabolic, like we saw the move to from 3,300 to 4,400. That was straight up without any kind of let up. So now we are kind of in the chop, but long term it looks great, and it's something that you can just accumulate and forget about it. And just like how people are talking about the treasury being the risk-free rate of return, I think we are going to come to a point where gold is going to be your risk-free rate of return, where whichever currency you're measuring it in. And it just makes sense. It just completely makes sense.
Yeah, I think that's where we're at in the markets at the moment. It's when you think about like these allocations of gold, or you think about long-term investments, so many people, I think they think about it in the wrong way, which is, I want to find something to invest in long term that's going to make me a ridiculous amount of money every single day, and I just wrote a thing about this yesterday. I've had, clients over the years have been the bane of my existence, to put it lightly. And I'm not trying to be an asshole, and I'm a terrible marketer. I'm probably a terrible person at sales. I'm probably bad at a lot of these things when it comes to trading. Um, but let's be honest, this is the one thing I come into a lot, which is, hey, why is I'll get a new client, let's say, especially when I ran managed accounts. So that means you have a bunch of accounts. Anybody can log in any day they want to and see like the market's up, the market's down, or your positions are up, your positions are down. And I'd have, if we were down on a day, people were losing their minds. I mean, I had a client who would send me like, hallelujah pictures when the market when our account was up. He'd be like hallelujah, their hands would be up, and there'd be all these gifts and crazy shit. And so I would just ignore it. And then the next day, if we had a red day, he would send me like videos or gifs of people like jumping off of buildings and stuff. Like this is, and honestly, like this is like a normal client. This sounds like really crazy, but this is almost like verbatim. Like I could make a copy of this person to be most of the clients out there. And what they really want is, and this is the reason why the hedge fund industry has gone to shit. Here's some truth here, which is everybody makes fun of the hedge funds. They're like, oh my God, hedge funds are bad investors. Hedge funds are the dumb money. Hedge funds are they're really not dumb money. However, their whole goal now isn't to make money. That might sound ridiculous. That's the goal, though. The goal isn't to make money. The goal is to have very low volatility while making as much money as they can. So, how people, why would they do that? Is that something that they decided, that did they back test it and found out that this makes more money over time? No. Clients are hard to deal with. However, if you can make a few percent here and there, not really have great returns, but just have stable returns, everybody's happy. You get a lot less phone calls and people don't blow you up every other day. However, if you back test this, how do you make money as a hedge fund or a trader in general? You have to have volatility. You could back test this over and over again. If you do not have drawdowns, if you can't take, if Kashop says, hey, I'm not going to buy any more of these exploration gold stocks. I'm tired of making all this money. Like, it's too volatile though. So now I'm going to just get into, I'm only going to own the S&P 500. I'm going to take a very small position in my portfolio. I'm going to do that. And I'm going to do exactly what Morgan says. I'm going to do 20% bonds, 20% gold. You're going to have really basic performance. And so the days of these, the funds used to make, some years 100%, 200%, crazy returns some years. And now it's 10%. Their goal is 10% and with low drawdowns. So what do clients want? Clients in their head think they're hiring a professional. Therefore, a professional can make me 1% a day every single day, and I won't have any drawdowns, and this will all be perfect, and I'll go live on a beach and have my returns. However, if you don't look at your account most of the time by the end of the year, even if you're having volatility, you're going to make money over the long run. So the biggest idea I'm trying to lay down here is the fact that, one, you need volatility to make money. Two is hedge funds are not stupid. They're doing this because this is what traders want nowadays. And it's sad, honestly. Not traders, sorry, investors. People who are real traders understand like volatility is going to come into play. If you own something like silver and you've made, let's say a 100%, 200% return on this over the last year and a half or so, like, you understand there's been a lot of volatility in there. There's been some 9% down days. There's been big up days. It's going to go back and forth. It's going to be messy. It's going to be annoying. But however, over the long run, you've made money. And now diversify that in all these different things. And now you've made more money. But now we're talking about, like, when I'm talking about, hey, I want a position to only lose 1% of my portfolio if this position goes against me. What they're looking at is, I want this position to only lose 25 basis points if this position goes against me. So if I'm only losing 25 basis points, what's my real upside? It's probably not much. So they're having smaller positions, lower volatility. This is what the investors want out there these days. So the hedge funds aren't dumb money. They're just trying to survive and they're trying to bring money in. It's like we were talking about earlier with ESG, like, it's either you're very low volatility and everybody likes you because everybody wants passive investments, or you're an ESG fund and you're playing on people's hopes and dreams and saying, hey, we're here to invest in things that are saving the planet. Like, think about the show Billions. Like, it's always, I always laugh at this one. You got the great quant who somehow becomes a quant who just wants to save the planet. Like, it doesn't even make sense. Like, you can't be a quant and then also just be a value investor. Like, those are two completely different things. So, I guess the overall theme here of what I'm saying is, think about markets in, like, I'm trying to make money. Think about diversification in your portfolio, as in maybe something like a 60-40 or 60-20-20 is something you might use for a retirement account. As a trader, this is a whole different thing, and understand, like, I'm going to have volatility. I'm going to be willing to take that volatility and so on. So, I'm a little bit off topic from where we were at, but like, I just wanted to add that context. So let's go through a couple more of these because we do have some time here today. So, Kashop, people have heard me talk about this. I wanted to pass this to you today because, to me, this is very easy to understand. But a lot of people can't, because it's a fundamental thing on top of a technical thing, which is when the yield curve is in a bull steepener, which means basically we have the short-term yields outperforming to the downside, underperforming to the downside, long-term yields, this creates more liquidity in the market, meaning banks can loan more money easily. Basically, banks lend from the short end of the curve, meaning like when you're seeing zero interest rates out there, that's not something I can go to the bank and get a zero interest rate for, but the banks can somewhere around that level. And then we're getting loaned mortgage rates and so on. This is at the long end of the curve. So this is where the 30-year is in the equation. So the 30-year yield. So let's say the 30 years at 3%, the short-term yield, let's say it's at 0%. Obviously, the bank's making a killing at that point. So now getting to where we're at today, we're still at elevated yields compared to that 0% zone that we were at around the 2020 zone. However, we're still at a point where the banks can be profitable. So what do you think about this? Do you think we're like kind of getting close to this liquidity, getting to the levels that are really going to boost oil and some of these other industrial metals like steel, aluminum? Also looking at the coal stocks are moving, which is something that's very fascinating. I've never seen a cycle where coal stocks have moved in history and then energy stocks just sat there stagnant. So what do you think about this one, Kashap?
So, bull steepener, which you talked about, it's the normal way of the world. So, bankers, the old bankers before it became such a big business, so they used to say, there was a saying that you borrow money at 3%, which is the amount of money interest you pay a depositors. You lend it at 6%, and you're in the golf course by 3 p.m. So it was a simple business, and that captures the bull steepness. So that's pretty much what you're doing. You're taking in deposits and you're promising them a particular rate of interest, and then you're making the margin because you're lending it at a higher level. And as long as you're doing your underwriting conservatively, then there isn't much risk of a loss, and you have a steady business. You have a steady, boring business. And banking used to be a boring business, but now we have all these different exotic instruments, and the industry is completely changed. It's now probably something like 20-30% of US industry is just finance. So we are in a completely different world. But even here, so bull steepener is a normal state of affairs. And when you see this happen, when you see the curve uninvert, when you see long rates at a higher level than the short rate, what's going to happen is it's going to fuel investment. And it's going to fuel investment for the simple reason that uh, long rates are rising, meaning, so people always say, like you said, that when interest rates are zero, that there's going to be more money sloshing around, which is true. But what we saw when interest rates went to zero was the banks weren't lending because there was no upside for them in lending. They could just park their excess reserves at the Fed or just lend short term to the commercial markets. But now, when you see attractive yields and when you see the bank's cost of capital also rising, they are now incentivized to take risk. And when there is a return of risk taking, and there is a return of demand for loans, then what's going to happen is it's going to go into the real economy. Instead of sitting as excess reserves, instead of just going to financial institutions, instead of just going into margin debt or treasury bonds, it's going to go into the real economy. And projects which could not get financed earlier because banks were like, why bother? They are now going to get financed. So you're going to see economic activity pick up. And when that happens, you're also going to see a lot of inflation. So like you point out, coal stocks are moving, the industrial metals are moving. So we are probably going to see some of the effect of the rate cuts go into the real economy. It's going to be easier for the industrials to refinance their old loans. It's going to be easier for them to raise credit. And a lot of them are going to do it just because you never know when the credit window will shut again. And companies have been in this position before, so they know it's better to be conservative and take the debt that they don't need now than risk it and a big happens, like let's say the AI bubble bursts and then credit markets dry up and then you can't get a loan again. So I think we're going to see lending activity pick up, and that's going to go into the real economy and cause higher inflation. So every road leads to inflation. I think however we talk about it, whatever we look at, it all comes back to inflation. And I think that's just going to be with us for a long time.
Yeah, so we'll go on for 10 minutes more. Usually we're off at 11. I have another commitment, but I am here for a little bit longer today. So, here's another chart which kind of illustrates the same idea. So, what's the opposite of inflation or a bull steepener phase? And that's the bear flattener phase. And that's where you see these red arrows on the yield curve. And so, everybody's getting a master class in bonds today. I love that. Sometimes I'm always like, I'm talking bonds, I'm all excited about bonds, but I know not a lot of people really understand what it is. However, it's like it is one of the most important asset classes in the market. You have to understand. I always talk about the fact that there's a bunch of different styles of trading to understand, and one is market structure. Understanding simply like we're in a bear flattener. Right now we're in a bull steepener. So these are bear flatteners. Bear flatteners mean there's less liquidity out there, and usually this leads to a higher dollar. As you see, most of the time you're seeing bounces in the dollar coincide around these same times, and bottoms in the dollar, or sorry, periods when the dollar is actually going down is usually when you're in that environment where we're in a bull steepener. And so the trade to actually take during the bull steepener time is, and the reason why we talk about this, and when you hear a trader who's a bond trader say, "I'm going to take a bull steepener trade," which is something I have on at the moment, we're going to be long the futures contracts. So in the 3-month bonds, these were called Eurodollar futures back in the day. Now they're called LIBOR. I still call them Eurodollar futures. Has nothing to do with the euro. That was the name before the euro was even created. But now we're looking at this and going, okay, I'm going to be long the basically where the Fed is cutting rates. The Fed's cutting rates and bonds are inverse. So I'm going to be long these 3-month bonds or 1-year bonds or even 2-year bonds. And then I'm going to be shorting 30-year bonds. So think about it like I'd be long, if you want to look at something that's easy to understand, I'd be long SHY, which is the ETF. ETFs don't make nearly as much money as the futures, which is the reason why you'll hear this mainly from futures traders. But SHY is something I'd be long. So if you look at that chart, you see like it's in an uptrend. IEI looks good too. It's in an uptrend. And then if you look longer in the curve, you look at TLT, that's in a downtrend. Yes, it's bounced recently, but it's massively underperforming. So either way you look at it, you're going to make money in that trade. So basically looking at it, okay, even if TLT is going up at the same time as SHY is going up, TLT is not going up nearly as much as SHY. So therefore, I'm going to make more money. Sorry, this is all very confusing. It's even confusing to talk about a little bit. But if you look at the charts of SHY, IEI, TLT, you're going to get an understanding of what I mean by all this. And it's really a masterclass in understanding liquidity. And liquidity is everything we're kind of talking about right here, right now. So looking at the dollar, I definitely see this scenario where we're still in a scenario where the dollar's most likely going to go lower. Now, will there be bounces in the dollar? Everybody loves to talk to me about the dollar and go, Jason, the dollar is going to go up for these reasons. Support zones or random things. It's like, no, structurally, the dollar's in a bad place. The one thing that I will say, though, is the dollar will bounce. And that's not like a prediction. That's just normal. Every single downtrend, whether you look at this chart, I mean, there's a bounce in every single downtrend. Positioning has gotten really, really, basically the dumb money basically has started to short this thing pretty heavily. And so at some point, this positioning is going to unwind. And so when this positioning unwinds, we're going to see bounces, and there'll be bounces. But I think it'll just bounce to lower highs. I don't think we're going to get back up to these. People are like, oh, we're going to get up and the dollar's going to be bullish again. It's like, I think we get to maybe 102 would be the max. 100 is kind of what I'm looking at the moment. If we start getting closes above there, sure, maybe I could change my mind. But as long as the market structure looks like this, where we're in this bull steepener environment, I don't think the dollar can really sustain a large uptrend. And it hasn't since that happened. Yes, there's been bounces. Yes, we were stuck in that range for a long time. That positioning got really, really offsides all the way up here. Basically, the dumb money was really, really long at that moment. And then it reversed, went down. Now the dumb money is really, really short, but the environment is set up for more downside in the dollar. So I wanted to ask you, Kashop, before we go, what are you thinking about the dollar? Do you think this is something that's going to come into play going forward? Do you think the dollar's doomed, or do you think the dollar is going to have one more fight for its life here?
I think it's going to lose its reserve currency status, and it's not going to be straight down for sure. There'll be bounces, like I said, but I don't think there's going to be one last hurrah. So the only caveat to this is if we get a massive crash like we got in 2008, and suddenly the dollar becomes a safe haven. So if you have a big deflationary shock, then temporarily dollar will go up, but then we all know what happens when there's a big deflationary shock. The Fed prints money and then the dollar goes straight down again. And the last time the Fed printed money in 2020, they printed at a rate of $100 billion a day. So it's 2025. Let's say we have a crash in 2026. Are they going to print at 200 billion a day, 250 billion a day? Is going to be a staggering amount of money, and the dollar will go right back down. So maybe we don't even get a safe haven trade, because now everyone knows the Fed is going to print massively, so why consider the dollar as safe haven? So maybe when there's a big deflationary crash, gold takes over the role of the dollar, or the Swiss franc takes over the role of the dollar and becomes a deflationary, the hedge for a deflation or a safe haven trade. So I don't
Hey, why
think
didn't you
the
say the
dollar.
yen? I'm just kidding. It's not 50
Yeah,
years ago.
yeah. So I think it's done. I think the dollar is done, and there's no way out of this mess now.
Yeah, I think that's true, and yeah, there's going to be bounces, and there could be small uptrends, there could be little things. It's kind of like bonds. The way I think about bond yields, yes, there will be periods of time where the 30-year yield will go lower, but in the long run, I think the 30-year yield is probably in an uptrend for possibly another decade. Um, it went sideways, everybody wrote it off. It's still sideways, everybody continues to write it off. Everybody loves bonds here because this is a thing that I learned early on in technical analysis, and this was something my uncle used to always say to me: is don't confuse the bottom of the chart with support. Don't confuse the top of the chart with resistance. And it's like that's what people are looking at TLT and thinking. They're like, okay, TLT, if you guys pull up a chart of TLT, you'll see it's like, it's hitting these lows. And if you look far back enough, you could see support zones all the way back there. Like yes, if you look really hard, you can find all these things. But however, it's structurally in a downtrend. I mean, it's the same as the dollar. It's structurally in a downtrend. It's the same thing for gold. It's structurally in an uptrend. SPY is structurally in an uptrend. So these are the reasons why, like, if you keep it simple, trading is a very simple process with humans who are very complex. And so what I mean by that is if you're looking at, a chart, and let's say I give it to a little kid and I say, "Hey kid, here's a chart of silver. What do you think about silver today?" Well, everybody's panicking, everybody's going, "Oh my God, it went up so much." And then it made it out of this thing and it didn't just take off. Like, no shit, it didn't take off. It's in a gapping uptrend. It's never gonna clear support easily. I've talked about this a million times, which is I grade breakouts. That would be a grade C breakout. However, it's consolidating now. But most kids could look at that chart, if you look at a long-term chart of silver, and they'd go, "Oh yeah, it's in an uptrend." Whereas traders are like, okay, well, support or resistance is here. Okay, well, sentiment is like this, and okay, and they think things through a little bit too much. And I think sometimes it's as simple as the dollar is in a downtrend. It looks bad. Bond yields are in a massive uptrend. Commodities are all moving one direction. The only one that hasn't joined the party is oil. Do you want to really bet against oil joining the party? Now, I'm not saying like go out and buy oil today and you're going to make all the money in the world. I'm saying that, be on the lookout for these things to move next, and then take the signals as you get them. If you're like a shop, you're using things like value and charts together. If you're like me, you're waiting for price levels to break. However you do it that way, and if you're some of my subscribers on Against All Odds Research, you guys know what I'm looking for, and you'll get the updates when I'm getting into these trades. But at the same time, like, keep trading simple, and just understand your own methodology. Like Kashop and I get on here every week. We have two very different trading strategies. However, we understand each other's enough, and we understand that, this is how Kashop does things. This is how I do things. but also our research amplifies what each other does, which is we could both be looking at something and see two different things, but for different reasons, and then come to the same conclusion. Something like the dollar. I'm just saying that this thing's breaking down. I'm seeing that it's nasty. I'm seeing that the positioning is pretty high, which means bounces. But I'm seeing the long-term structure of the bond market and the long-term structure of global liquidity and the shift out of dollars is telling me that it's a downtrend. Kashop just gave you all of his great reasons why the dollar probably isn't going to move up as well. So, understand what you do and then do it well. But Kashop, you have anything to end this on? I'm about out of work, out of business, out of everything. I can't even say words anymore. Jesus.
No,
I've
I
used it
think you
all.
nailed it.
We've been
I
on
think
for
you
an hour
nailed
and
it.
hour and a half now.
Yeah. Yeah, I think you nailed it. So even though we have different styles, I have learned a lot from you, like all the indicators, when to put them on. Most of the times I don't look at it, but I know exactly when to look at it. And then when we look at a chart together and I see, oh yeah, I see what you've done. So you've put out this 40-day high or this 200-day high or whatever, and then I get the reasoning for it. So
Mhm.
it's a complementary style. So when you see, so I do macro fundamentals valuation and you do macro and price, if
Mhm.
I have your
Yep, that's right.
method right.
Yep.
Yeah. So it works. It really works together. And when you do individual stocks, you kind of do get into the fundamentals and the valuation as well. So it absolutely works. Whichever style it is, you can definitely learn from the other style and not be like, oh, this is shit. Like, me
Mhm.
may say that Gann angles are shit, but you never know. It may work for someone. So, no,
Scan angles are
no.
shit. I put out a fan principle chart the other day for the first time, and Sam was like, "Wow, that's a really freaky chart for you." I'm like, "Yeah, it's rare that I put something out like that, but once in a while, like I might put something kind of odd out like that, like just looking at things, seeing something, wanting to put out something different. But mainly for me, it's an idea when I put something out different is to, hey, I don't think everybody's seen something like this before. I always thought this was a cool idea when I was younger. Maybe somebody could get something from it. So sometimes I'll put out charts like that.
Yeah.
Well,
So,
cool
all right,
guys.
we had a great long session today. So, thanks everyone. Thanks for making it kind of interactive. It was fun.
Yeah, this was a good time. All right, guys, take it easy. We will be. Yeah, we're. I see Shell is in here. Somebody's talking about Shell. Yeah, I'm long Shell as well. That's a good one. If you guys are on the channel, you guys got that trade alert quite some time ago. So, all right, guys, take it easy, and we'll see you guys next week at Friday at 10 a.m. Eastern time. Take it easy.